Hello and welcome. Today we're tackling a really big topic, how the UK's 2025 budget is going to directly affect your savings. And we're not doing this alone. We've got an incredible analysis put together by the experts over at Pro Tax Accountant to guide us through it all. All right, let's jump right in. These are the folks who have literally waded through all the complicated government speak and fine print so you don't have to. They've boiled it all down to give us a super clear picture of what's heading our way. So let's get right to it with a pretty serious question. Are your savings about to get a haircut from the tax man without you even noticing? Because, and I'm not exaggerating here, the UK budget for 2025 has kicked off some of the biggest changes to savings we've seen in a generation. This isn't just some minor tinkering around the edges. No, this is a fundamental shift in how your hard-earned money is going to be treated. So you might be asking, why? Why is all this happening? Well, this number right here tells a big part of the story. By 2030, the UK's total tax burden is set to hit a record-breaking 38.3% of GDP. To put it plainly, the government needs money, and it looks like our savings are right in the crosshairs. Okay, we've got a fair bit to get through, so here's a quick roadmap. We'll start with the new savings landscape, then dive into the big changes for your ISA. After that, we'll cover the squeeze on investments, what this all means for pensions and your pay packet, and then the most important part, we'll wrap it all up with a clear action plan for you. All right, first up, the new savings landscape. We're calling this the silent squeeze on your money, and you're about to see why that name is so fitting. So there's this one key idea you've got to get your head around, and it's called fiscal drag. Now, I know it sounds a bit technical, but it's basically a stealth tax. Here's how it works. Inflation happens, maybe you get a pay rise, but the tax brackets don't move. So you quietly get pushed into a higher tax bracket, and suddenly you're paying more tax even though the government never actually announced they were raising tax rates. Sneaky, right? And here's what that actually means for you. These tax thresholds are frozen solid until 2031. Think about that. It means an estimated 5.2 million more people will start paying income tax, and another 4.8 million will be pushed into the higher rate tax band. And as your income creeps up, your personal savings allowance, that bit of savings interest you get tax-free, it shrinks, or could even disappear completely. That's not all, though. Here's where it gets even more personal. This brings us to Section 2. Your ISA is changing. And we're talking a major overhaul here. This is where the changes really start to hit home and mess with the saving strategies we've all been using for years. Okay, look at this. This is the big one. Right now, you can pop up to £20,000 a year into a cash ISA, totally tax-free. But from April 2027, if you're under 65, that allowance gets slashed almost in half, down to just £12,000. That is a massive hit for anyone building up an emergency fund or saving for a house deposit. But here's a little pro tip for you. This change is specifically aimed at savers under 65. If you're 65 or over, guess what? You get to keep your full £20,000 cash ISA allowance. It's a move designed to protect retirees. Now, these changes aren't all happening at once, so getting the timeline straight is absolutely crucial. You've got the government looking at the lifetime ISA in early 2026. Then, bam, April 2026, dividend tax rates go up. But the date you really need to circle in your calendar is April 6th, 2027. That's D-Day, when the new ISA limit and the higher savings taxes both hit at the same time. And speaking of the lifetime ISA, this quote from Rachel Griffin over at Quilter really nails why they're shaking things up. She says, the lifetime ISA has attempted to serve two distinct goals, but has failed to meet either effectively. Basically, it tried to be a jack of all trades and ended up being a master of none. The idea is to replace it with something simpler just for first-time buyers, but that could leave a lot of self-employed people who were using it for retirement out in the cold. Okay, so your ability to save tax-free in cash is taking a hit. But what about any money you've got in investments outside of an ISA? Well, that brings us neatly to Section 3, the squeeze on your investments. And you're going to want to stay with me for this, because this next part might genuinely surprise you. Just take a look at this table. It lays it all out in black and white. From April 2026, the tax on your dividends is jumping up by 2%. Then, a year later, the tax on your savings interest does the exact same thing, up by 2% no matter which tax bracket you're in. The bottom line? Any money you have sitting in a normal savings account or in shares that aren't in an ISA, it's just going to work less hard for you from now on. And here's a quick did you know for you. This isn't just pocket change we're talking about. These tax hikes are expected to rake in an extra 1.7 billion pounds for the government every single year. That just shows you how massive these changes really are.
But we're not done yet. The changes don't just stop at ISAs and investments. Nope. They're also coming for a really popular and tax-savvy way to save into your pension. This is where things can start to affect your take-home pay directly.
What I'm talking about is salary sacrifice. For a lot of people, it's a brilliant setup. You agree to take a slightly lower salary on paper, and in return, your employer pays that difference straight into your pension. And the magic part? Neither of you pays national insurance on that chunk of cash. It's a win-win that helps your pension grow so much faster. Well, that's changing too. From April 2029, that amazing national insurance break is getting capped at just £2,000 a year. Anything you sacrifice above that is going to get hit with national insurance. So not only does that make it more expensive for you to save more, but it might also make employers think twice about offering those really generous pension matches they used to. And if you want to see the real-world impact, just look at this chart. Let's take a 22-year-old earning £25,000. With the current salary sacrifice perks, their final pension pot could be around £283,000, but without that boost, it drops to £226,000. That's a difference of £57,000 over a lifetime. It's a massive, massive difference. Okay, wow, that was a lot to take in, I know. We've talked fiscal drag, ISA cuts, tax hikes, pension changes. It's a minefield. So the big question is, what on earth are you supposed to do about all this? Well, that brings us to the most important part of our chat today, your action plan. To bring this all to life, let's think about someone like Maria. She's 35, a freelancer living in London. She doesn't have a company pension, so ISAs are her go-to. Suddenly, the cash ISA cut makes it harder to save an emergency fund. The dividend tax hike chips away at her small investment pot. And getting rid of the Lisa, well, that throws her plans for buying her first home into chaos. See, these aren't just numbers on a screen. They affect real people just trying to get ahead. So here is a simple 4-step savings review you can do. 1. Look at your ISAs. You have until April 2027 to use that full £20,000 allowance. It's a real use it or lose it situation. 2. Reevaluate your investments. With dividend tax going up in 2026, it makes a ton of sense to move any high dividend stocks into a stocks and shares ISA, like now. 3. Check your pension. If you use salary sacrifice, you need to understand how these new rules after 2029 are going to affect you. And 4. Get those key dates, 2026, 2027, and 2029 in your calendar. Seriously, do it today.
If your head is spinning with all this, just try to remember these key numbers. £12,000, that's the new cash ISA limit for most people. 2%, that's how much most savings and dividend taxes are going up. £2,000, that's the new salary sacrifice cap. And the dates? April 2026 for dividend tax, and the big one, April 2027 for the ISA limit drop and savings tax hike.
And that brings us to our final section, getting some expert advice and figuring out your next step. Because let's be honest, knowing all these rules is one thing, applying them to your own life, that's a whole different ballgame. The truth is, the whole savings landscape is getting way more complicated. The old simple rulebook is basically being thrown out. What worked for you last year probably isn't the best plan for next year. And that's why getting personalized advice from someone who really knows their stuff has never been more critical. And if you want to talk to a professional, the team at Tax Accountant, the experts who put this whole analysis together, are there to help. They can give you expert guidance on how this budget affects you personally. You can reach them on WhatsApp or by phone at 07985 689912 or just drop them an email. Now, just before we finish, a quick but important disclaimer. The information we've shared today is for general guidance only. It's really not meant to be the sole basis for your financial decisions. So before you make any big moves, you really must consult with a tax expert, like the team at Tax Accountant, who can give you advice that's tailored specifically to you. So we'll leave you with one last thought to chew on. Your savings strategy for 2025, it's pretty much obsolete now. The game has changed. The only question left is, what's your next move?